In our last analysis, I gave you a very specific technical warning. I said that if silver did not hold the 150-day exponential moving average on the hourly chart near $90, we were headed for $84.90 and below. As of this recording, Western spot silver is sitting at $79 and Western futures are at $81. The level did not hold. If you think this is hindsight, go back and watch the time-stamped public documentation on my X and YouTube feeds. I didn't give you 1,000 scenarios. I gave you one. Lose that moving average, and we are going lower. Period. But here is the scale of the carnage. In just 80 minutes this morning, $1 trillion was wiped from the combined market cap of precious metals. Gold dropped 2%, erasing roughly $740 billion. Silver dropped between 10 and 11% in that same window, erasing around $260 billion. 80 minutes. That is not a market reacting to news. That is a market being moved with surgical precision. The United States dollar is up 1% today, challenging highs not seen since January 15th. The NASDAQ and S&P are in the red, while European natural gas has surged another 20% today. That is a 70% increase in just 48 hours. But here is the open loop that should keep you on high alert. While the Western paper markets were crashing, the South Korean Kospi reopened after a holiday and immediately plunged 7%, erasing $270 billion in a single session. This is the largest one-day crash in Korea since the August 2024 yen carry trade crisis. A massive wave of pent-up selling is finally hitting the markets as they try to price in a war that has expanded to 15 countries. Why would silver drop 11% in 80 minutes while oil infrastructure is being systematically targeted and energy routes are collapsing? The answer involves an algorithmic growth scare and a 62-to-1 ratio that is about to snap against every physical reality on the planet, a disconnect so large it has forced a major Eastern exchange to do something they have never done before. To understand why silver got hit harder than gold, you have to understand the algorithmic regime. Silver carries roughly 60% industrial demand from solar, electric vehicles, and defense manufacturing. When a supply shock of this scale hits, the algorithms price in a growth scare. They assume that if energy is cut off, factories will stop and industrial demand will vanish. Gold doesn't have this problem. No factory needs gold to operate. In this regime, gold leads and industrial metals lag. This part is textbook. But look at the prices depending on where you are. Western spot is $79 and Western futures are $81. Meanwhile, Shanghai spot is at $91 and Shanghai futures are at $92. That is a $12 premium still intact after an 11% crash in the West. Now, look at the ratios. The gold to silver ratio in the paper markets is currently 62-to-1. But look at the physical reality. The mining ratio, the actual metal coming out of the ground, is 1-to-7. The COMEX vault ratio is 1-to-11. The LBMA vault ratio is 1-to-3. And the available above-ground supply is nearly 1-to-1. One of these numbers has to snap. The paper ratio of 62-to-1 is so disconnected from every physical and production reality that the math alone tells you this must resolve. But here is the open loop that signals a massive cover-up in the East. The Shanghai Gold Exchange just released its weekly report, and for the first time in its history, the silver inventory data is completely gone. Gold volumes were reported, but every line for silver inventory was blank or zeroed out. This is the same exchange that publishes detailed stock data every single week. Why would a major exchange go dark on their silver numbers in the middle of a historic price surge and geopolitical chaos? When an exchange stops reporting inventory mid-crisis, it isn't a clerical error, it's a decision. What are they hiding? The answer lies in the rising lease rates and a negative swap that are currently screaming physical supply stress, despite what you see on the price screen. And it points to a massive withdrawal event involving 3 of the world's largest bullion banks. When silver hit $83 recently, we saw lease rates begin to creep higher. For those who don't track the plumbing, rising lease rates and a negative swap are early warning signals for physical supply stress. It means the cost of borrowing physical silver is rising because the metal isn't available. The futures curve is pricing in backwardation risk. So, while the paper price in the West dropped to $79, the physical stress indicators moved in the exact opposite direction. The COMEX tells the same story. 2,800,000 ounces were withdrawn from the vaults on Friday alone, pulled from Brinks, CNT, and JP Morgan simultaneously. Total COMEX inventory is still net declining. At the same time, the Shanghai Futures Exchange suspended 5 more groups of accounts today for trading violations. 2 major Chinese market actions on the same day, an inventory blackout at the SGE, and account suspensions at the SHFE. These are not coincidences. This is an exchange moving to stop someone from playing games with positioning during a crisis. But here is the open loop that identifies the predator in the room. We have a new largest holder of the BlackRock Silver Trust. Jane Street just purchased 20,600,000 shares in a single quarter, over 3.5% of all outstanding shares. This is a firm where over 87% of their massive portfolio is held in options. They generate profit by creating and trading volatility using massive leverage. And the structure is simple. Build a large position in the underlying asset, run a massive option trade on the side, and then engineer a price move to cash out. But there is a documented history here that the mainstream won't mention. We are about to look at the Terraform Labs lawsuit and the 10 a.m. Bitcoin dump that proves this firm has a history of market manipulation. Is the 80-minute silver bloodbath just another scheduled dump to clear out the retail longs? In India, regulators have already documented how Jane Street manipulated the cash market to profit from derivatives positions. We saw the same pattern in crypto. Terraform Labs filed a lawsuit accusing them of similar tactics during the $40 billion Terra collapse. And then there was the daily 10 a.m. Eastern dump in Bitcoin, a pattern so mechanical it only stopped after the lawsuit went public. The structure is always the same. Build the position, run the derivatives on top, move the price, and collect. And who holds the physical silver backing this SLV position? J.P. Morgan, a bank that has already paid nearly $1 billion in fines for manipulating the precious metals markets. When the firm that stores the metal and the firm that owns the most shares both have documented histories of manipulation, an 11% crash in 80 minutes doesn't look like an accident. During a genuine liquidity squeeze, all asset correlations collapse toward one. Everything sells for cash, stocks, bonds, and metals. Only the dollar rises. That is what we are seeing today. But here is the open loop that changes the oil picture entirely. The port of Fujairah, the UAE's only significant shipping route that bypasses the Strait of Hormuz, was just hit by a massive explosion. Iran is now directly targeting the workaround routes, not just the strait itself. Simultaneously, Iraq has shut down the Rumaila field, the second largest oil field in the world. 30% of Iraq's total output is now offline. Why is oil production stopping when the world is starving for energy? The answer is storage capacity, and it is about to force a triple-digit reality that no paper dump can stop, starting with a specific Iranian missile threat that has Saudi Aramco on high alert. When tankers cannot move through the Gulf, storage tanks fill up. When storage fills up, production must stop. That is exactly what is happening in Iraq right now. Oil moved from $72 to $76 today, despite the broader market sell-off. Physical supply pressure is starting to overcome paper pressure. The United States has now warned of imminent Iranian attacks targeting Dhahran. Saudi Arabia, the home of Saudi Aramco, the world's largest oil company. Israel has indicated that the Saudis may even be preparing to strike Iran directly. The geopolitical fracture lines are now fully drawn. The United States and Israel on one side, and Iran with Chinese diplomatic backing on the other. Even as the paper markets bleed, a new class of buyer has entered the silver market. The CEO of Scottsdale Mint recently disclosed that a publicly traded company is currently adding a large and unprecedented amount of physical silver to its treasury management. We are no longer just seeing retail stackers. We are seeing corporations treating physical silver as a treasury reserve asset. When companies with billions on their balance sheets stop trusting the banking system and start trusting the vault, the exit door for the paper shorts begins to slam shut. But here is the open loop that identifies the final black swan for the Western exchanges. While the paper price was being smashed to $79, rumors are emerging that a major central bank in the East is about to demand physical settlement only for all silver contracts on their exchange. If one major exchange stops accepting paper settlement, the arbitrage will force every ounce of metal out of London and New York in a matter of days. We are about to reveal the final liquidity trap. And the one technical level, silver must reclaim tonight to prove the bloodbath was just a trap for the uninformed. Let's look at the resistance case with intellectual honesty. Silver broke down technically today. The 150 EMA on the hourly did not hold. In a full liquidity squeeze, even structurally sound assets get liquidated for cash. Western mining stocks are not following the Chinese miners higher, which is a warning that institutional commitment in the West is still lacking. If the dollar continues to push higher, metals will face more headwinds in the short term. Cash is currently king, and margin calls are forcing liquidations everywhere. However, the physical reality has not changed. The SGE went dark on inventory data during peak stress. 2,800,000 ounces left the COMEX vaults in a single day. Lease rates are rising. The paper ratio of 62 to 1 is a mathematical fiction compared to the 1 to 7 mining ratio. The fact that public companies are now treating silver as a treasury reserve asset tells you that the smart money is positioning for a world where paper promises are worthless. They aren't watching the 80-minute dumps. They are watching the vault drains. The strategy for this week is clear. Do not trust the price on the screen if it contradicts the data in the vault. If silver is at $79 while the East is paying a $12 premium and the inventory data is being blacked out, you're looking at a liquidity trap designed to shake you out before the next leg up. Position yourself with logic, not hype. Watch the $81 level on the futures. If we reclaim that, the paper slam has failed. But here is the final open loop before we close. The March delivery window for silver officially opens in 48 hours. With the vaults draining and the East going dark on data, there is one specific entity that has just stood for delivery on 10 million ounces, and it is on a bank. It's a sovereign wealth fund that has never touched the silver market before. If they demand physical delivery and the metal isn't there, the paper game ends on Friday. We will be tracking that delivery notice the second it hits the tape. OG out and about.